Financial statements are written reports which quantitatively describe the financial position of a company. They include trading, profit and loss account, and a balance sheet. Financial statements are usually compiled on a quarterly, semi-annual, and annual basis. Financial statements are written reports which quantitatively describe the objectives. By the end of the topic, you should be able to identify the various financial statements, explain the importance of each of the financial statements, explain the concept of trading period, prepare simple financial statements, explain the various types of capital, calculate basic ratios from financial statements, and explain the importance of each of the basic financial ratios. Background. In Form 3, we learned how to prepare a simple balance sheet, which is one of the financial statements. In this topic, we shall expound more on the balance sheet and other financial statements such as trading, profit and loss account, and their importance to the business. Click on the play button to view financial statements. Introduction. Business records as they appear in journals and ledgers may not be of much help to a business in decision-making. They are more useful when summarized into trading, profit and loss account, and balance sheet. Besides, accounting ratios assist in determining financial stability of a business, pricing policies, among others. Importance of each financial statement. Trading account enables a business to determine or establish the value or cost of goods available for sale. Determines the cost of goods sold. Used for comparison of business performance over a period of time. Determines gross profit or loss of a business over a period of time. Determines the net purchases and sales of the business over a given period of time. Importance of profit and loss account. Determine total expenses incurred in running the business for a given trading period. Determine the revenues received during the trading period. Determines whether it has made net profit or net loss in given trading period. And the government can use it for taxation purposes. Importance of the balance sheet. Determine the total value of assets of a business. Determine the total capital of a business. Determine total liabilities of a business. An indicator of business growth over time, and determines the liquidity of a business. Trading period is a time length for which business financial statements are prepared. This period can cover 3, 6, or 12 months depending on the wish of a business. Preparing simple financial statements. Note that a business cannot make a gross profit and incur gross loss at the same time. Gross profit is realized when credit side exceeds the debit side, and it appears on the debit side as gross profit carried down. At the same time, gross loss is incurred when the debit side exceeds the credit side, and it appears on the credit side as gross loss carried down. Gross loss is incurred when the debit side exceeds the credit side, and it appears on the credit side as gross loss carried down. Meaning of terms used in trading account. Opening stock, value of goods at the start of a trading period. Closing stock, value of unsold goods at the end of a trading period. Drawings, value of goods taken away from the business for personal use by the proprietor. Carriage inwards or carriage on purchases. Expenses of transporting purchases or goods bought into the business. Net sales or turnover. Value of sales, less sales returns or returns inwards. Net purchases, value of purchases, less purchases returns. Example: the following information relates to Ole Magello Traders for the period ended 31st December 2010. Stock 1st January 2010, 40,000 Kenya shillings. Sales returns 3,000. Purchases returns 2,000. Sales 300,000 Kenya shillings. Stock on 31st December 2010, 30,000. Purchases 180,000. Carriage inwards 6,000. In the course of the year, Ole Magello took goods worth 4,000 Kenya shillings for personal use. Required: prepare Ole Magello's trading account for the period ended 31st December 2010. The following information relates to Nyaboke Traders for the period ending 31st December 2009. Sales 30,000. Purchases 16,000. Sales returns 1,000. Purchases returns 2,500. Opening stock 10,000. Closing stock 8,300. Required. Prepare Nyaboke's trading account for the period ending 31st December 2009. Exercise. The following information was extracted from the books of Lotodo's traders for the period ending 30th June 2010. Wages 1,200. General expenses 5,100. Gross profit 22,050. Interest on loan 3,750. Interest on debentures 1,400. Advertisement 11,600. Discount received 500. Exercise. The following information was extracted from the books of Lotodo's traders for the period ending Balance sheet format. Quiz 1. The balance sheet format. Quiz 1. Balance sheet format. Quiz 1. The balance sheet. When preparing the balance sheet, net profit or loss, drawing and additional investment are adjusted on the initial capital to arrive at the final capital. Balance sheet format. Quiz 1. The balance sheet. When preparing the balance sheet, net profit or loss, drawing and additional investment are adjusted on the initial capital to arrive at the final capital. Various types of capital. Working capital is excess of current assets over current liabilities. It represents funds available for a business to meet its day-to-day financial obligations. It is calculated as working capital is equal to total current assets minus total current liabilities. Example, Olemagelo's working capital. Total current assets 207,000. Total current liabilities 4,820. Therefore, working capital is equal to 207,000 minus 4,820, which is equal to 202,180 Kenya shillings. Calculating basic ratios. Financial ratios analysis is comparison in which certain financial statement items are divided to show some relationship that provide indication of financial performance of a business. Margin. This is the ratio of gross profit to sales and is calculated as margin equals to gross profit over sales multiplied by 100. From Ole Magello's business, gross profit equals to 107,000 and sales 297,000. Margin equals to 107,000 divided by 297,000 multiplied by 100, which is equal to 36.03%. Importance of margin. It determines the rate of profitability on sales and is used in pricing policy of the business. Markup. This is ratio of gross profit to cost of sales or cost of goods sold and is calculated as markup is equal to gross profit divided by cost of sales multiplied by 100. Example from Ole Magello's business, gross profit equals 107,000 and cost of sales equals 220,000 Kenya shillings. Markup equals to 107,000 divided by 220,000 multiplied by 100, which is equal to 48.64%. Importance of markup. It determines the rate of profitability on cost of goods sold and it assists in the pricing policy of the business. Current ratio or working capital ratio. This is the ratio of current assets to liabilities and is calculated as current ratio equals current assets divided by current liabilities. From Ole Magello's business, current or working capital ratio equals to 207,000 divided by 4,820, which is equal to 42.95 to the ratio of 1. Importance of current or working capital ratio. It shows the amount of current assets available to offset current liabilities and it indicates the solvency or financial stability of the business. Rate of stock turnover. It shows the number of times stock is bought and sold within a given financial year. It is calculated as rate of stock turnover equals cost of sales divided by average stock, where average stock equals to opening stock plus closing stock divided by 2. Example. From Ole Magello's business, cost of sales equals 190,000, opening stock equals 40,000 and closing stock equals 30,000. Rate of stock turnover equals 190,000 divided by 40,000 plus 30,000 divided by 2, which is equal to 190,000 divided by 35,000, which is equal to 5.43 times. Importance of rate of stock turnover. Shows the number of times the stock is bought and sold during the trading period, and it assists in determining stock levels to avoid overstocking or understocking. Return on capital. This is net profit expressed as a percentage of capital invested. Return on capital equals net profit divided by capital invested multiplied by 100, or net profit divided by capital employed multiplied by 100. Example. From Ole Magello's business, net profit equals 62,280, capital employed equals 222,180, and capital invested equals 153,900. Return on capital equals 62,280 divided by 153,900 multiplied by 100, which is equal to 40.47%, or equals to 62,280 divided by 222,180 multiplied by 100, which equals to 28.03%. Importance of return capital. It determines the amount of profit made in relation to capital invested or capital employed, and it assists in decision-making on whether to continue with the business or change to another form of business. Financial statements are written. Type in the type of capital that matches the description given. Type in the type of capital that matches the description given.